This video has been brought to you by financetrainingcourse.com. For a number of additional similar courses, training materials in PDF file format, sample Excel files, and models, please see financetrainingcourse.com. Thank you. Hello, my name is Jawwad and today I present the Quant Crash Course. The Quant Crash Course is meant for people who deal with topics in computational finance and are required to work with value at risk, market, credit, operational risk, as well as capital allocation, capital attribution, capital adequacy, limit management, and the limit control framework. The Quant Crash Course has four primary pieces. The first piece focuses on the context around risk management. The second looks at value at risk. The third walks us through capital management and capital allocation. And the fourth and final piece looks at limits and controls. Within part one, or the context piece, we look at the philosophy of risk. We look at the concept of understanding the distribution or the generator function as defined by Nicholas Nassim Taleb. We review volatility and correlation. In part two, we look at the calculation of value at risk, but we don't just stop at calculation methods. We also look at exceptions around the tool. We look at the mindset as well as the debate that Nassim Taleb triggered around the efficacy of value at risk for both risk and trading desks. In our third piece, we look at capital management. The primary framework for capital management is capital adequacy as well as capital allocation. And that leads us directly to the last and final piece around limit management. Within limit management, the key area that we cover and review is linking stop loss and value at risk, as well as applying value at risk as the primary mechanism for estimating pre-settlement risk. We'll now start with the context section of our course. When I first started working in this field, I actually believed that there is a state of risk nirvana that could be reached if you were to only apply the principles in this field correctly. And in such a state, all risk would be neutralized and optimized, and we'd all be able to effortlessly walk the line between risk and reward. However, real life is very different. Over the years, I've realized that while we would certainly like to reach, and we would all like to reach such a state, reality is very different. In real life, the function of risk management cannot stop us from failing, from losing money, or even facing catastrophic failure. However, what the field can do is ensure that when such events occur, our response and reaction to them are a lot more graceful than what you see in front of you in the screen. Over the years, as I read more and more about this literature and dealt more and more with challenges that I faced as part of my work, there was one thing that kept on coming back to me. Our responses to events that we had not foretold or forecasted, our responses to breakdown of markets, our responses to significant losses, were all driven by our ability to what Nicholas Nassim Taleb calls understanding the distribution or understanding the generator function. So, what is this distribution? What you see in front of you is a diagram, is a graph. What this graph basically does is lay out the number of accounts or the amount of value that you have booked on your balance sheet for your credit portfolio. At the bottom of the screen or the graph, you see a scale that goes from 1 to 12. This is an internal credit rating scale where 1, 2, 3, and 4 are good, and 10, 11, 12 represent trouble and problems. As you can see, the way the graph is laid out is that one section or one cluster is right at the beginning, starting from rating scale 1 all the way up to rating scale 5. And then there is another cluster right towards the troubled end starting from 10, 11, and 12. In statistical terms, we call this graph or this diagram a histogram. In essence, what it does is that it takes a series, it sorts it, it clubs it into buckets ranging from 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and 12, and then it presents the results in front of us. A histogram is an easy way of eyeballing a series and assessing how the distribution is laid out. What you see in front of you right now is the distribution of an actual credit portfolio in the month of June across rating grades 1 to 12 and ranging from values going from 0 all the way up to a billion units of currency. So when Nassim Taleb says understand the distribution, Nassim's point is that such a static snapshot is not necessarily enough. We actually have to delve a lot deeper for us to get comfortable with the surprises or the unexpected challenges this distribution is likely to throw at us. Our awareness and our understanding of this distribution has a direct impact on the effectiveness of a risk management function as well as the grace with which we may be able to handle losses the market may throw at us when we move into the future. So, what are the primary elements, or what is the practice of understanding the distribution? First, let's take a look at another example. Here's one more distribution. However, in this specific instance, rather than dealing with credit, what we're really looking at is the change in the price of crude oil on a monthly basis. And as you can see, in this distribution, the range of changes goes from minus 27% a month to 14% or more. In the middle, you see the most frequent occurrence, which in this case is 0. So if I were to do a literal translation of this graph, I would say that the most likely event when it comes to changes in the price of crude oil from one month to the next is a change of 0%. The next likely is a positive change of plus 5%, followed by a positive change of plus 10%, followed by a positive change of minus 4%. So how does this work, or how is this different? As you can see, in this case, in the previous case, when we looked at the credit portfolio, the primary element that we were tracking was internal rating. Internal rating is an interesting phenomenon in the sense that it's driven by data from the client as well as the payment behavior of that client recorded by the bank. You take these two to figure out what the rating scale for this customer would be from one month to the next. In the second example, which is the change in the price of crude oil, the change is market driven. Market prices are recorded. Changes in those market prices fall in the appropriate bucket in the graph that you see in front of you, and then we work with this series to figure out what's the most likely probability, what's the most likely chance of us seeing a change in the value of crude oil from one month to the next. Here's the third. In this example, rather than dealing with credit portfolio or crude oil, we're actually dealing with the exchange rate between the Australian dollar and the US dollar. Unlike the first two examples, you can clearly see that the distribution here is a lot more clustered towards the center. The range of values also range from minus 6% on one side to plus 5% on the other. Once again, the most likely event, and this time rather than looking at monthly changes, we are looking at daily changes. The most likely event here is a change of about 0%, followed by a change of just over 4%, followed by a change of just over minus 2%. So the three things that we see, the three things that are common in the examples that we just placed, on the credit side we can see that the distribution is clustered towards two separate ends. In statistical terms, we'd call this a bimodal distribution. In the second instance, we see that it's certainly skewed, and it's skewed towards the right or skewed towards the positive side rather than the negative side. In the third instance, we see clustering that's happening in the center. Right? So if you were to use these three examples to work with as a basis for understanding the distribution, where would you start? The first question that I would throw at you is assessing the effectiveness. Now, effectiveness is an interesting word. How does this apply in this specific context? If you remember, the first example that we saw was one of a credit portfolio. If we skip back quickly, here's the example that we saw earlier. A credit portfolio ranging from 1 to 12, clustered around two specific segments for the month of June. In this example, we're looking at a slightly different credit portfolio from a different client and a different bank. However, rather than looking at scores going from 1 to 12, we're actually looking at scores going from 0 to 100. In this instance, 100 is good and 0 is bad. We again see clustering happening in the middle. So the first question I ask whenever I teach this course is that when you see this distribution and you see this distribution and compare it with the first three, what stands out immediately? Credit, oil, currency markets, and credit again. Let me pose the same question in a slightly different fashion. If you were the board of directors who was reviewing the performance of the credit manager, whose efforts led to the creation of the histogram that you see in front of you, how would you evaluate the effectiveness of the credit function? Would you retain this credit manager? Would you give this credit manager a bonus? Or would you fire him? Three questions. If this is the only information you have in front of you, in addition to the three examples you'd seen earlier, would you say that the underlying credit function behind this distribution is effective or not? So hold that thought, hold the answer to this question, and we will come back to this later on. The second element or dimension of understanding the distribution is looking at behavior. In the first instance, we looked at the results for the month of June. This is the same credit portfolio. However, rather than looking at just one specific instance, in this case, we're looking at the series starting from February, March, April, May, and June. Evaluating, assessing, and looking at the distribution over a period of time is an important aspect of dissecting the distribution, an important aspect of understanding how the distribution behaves over a period of time. It's important not just in your ability to determine seasonal changes in impact, but it also shows you what to expect with this distribution depending on not just the time frame, the economic cycle, the environment, or the structure and breakdown of your market from one moment to the next. The third piece of this dimension is dissection. So in this case, we've taken the same credit portfolio and we've broken it down by different sectors, going from autos all the way up to transport. In addition to sectors, we've also taken the effort to dissect the products or dissect the credit portfolio by underlying products, starting from lease finance, long-term finance, short-term finance, and medium-term finance. All of this, effectiveness, behavior, and dissection, help us towards the end goal. And the end goal, as I said earlier, is our ability to see how the distribution that we're dealing and working with behaves over a period of time. This understanding can come from the underlying structure, behavior of this over a period of time, identification if of any clustering towards the center or the ends, reviewing the underlying process to see if there is a physical, tangible change in the distribution on account of the risk function that has been put in place, evaluating behavior over a period of time, and dissecting your exposure to see what is your really troubled spot. So if you're armed with the histogram and you've done a good job of understanding distribution, the next piece that comes in is the relationship between distribution and volatility, or sigma. At some point in time, all of you must have done an introductory course in statistics. You came from finance, economics, engineering, or science background. Um, Somewhere in your undergraduate or graduate programs, you would have been introduced to the concept of standard deviation, or sigma. Sigma has many names. The statistical name is variance. We also know it as the square root of variance, or standard deviation. If you pick up a text on computational finance, you'll see the word dispersion or diffusion, referring to the same concept. If you move into trading and finance desk, you'll see the term volatility, or vol for short. And then once you start playing with vol, you add two more dimensions. One is what we call trading volatility. Second is called implied volatility. Think of trading volatility, or rather, before introducing trading volatility, let's take a look at a simple example. If you were to use historical prices, and those historical prices give you a volatility, or vol for short, of 5%, would you trade a security or a product? When I say trade, I mean, would you buy or sell that product at the historical or empirical volatility realized by the markets over the last 3, 6, 9, or 12 months? A short answer to this question is, in most cases, no. Empirical or historical volatility is just an indication of what the market, or where the market was when it came to volatility. There is no assurance, there is no guarantee that you will see similar levels in the future, which basically means that depending on your position, you would either buy the security or sell the security at a level which is different from historical and empirical levels. This represents trading vol. What is the vol at which you are willing to trade this security? Related to trading vol is the concept of implied volatility. If you use empirical volatility to calculate the price of a security, and that price is different from the market price, implied vol represents the level of vol where the price of your model matches the price of the market. In essence, implied vol is a concept very similar to trading vol. However, you're saying the market believes that the correct trading price for this security is at this level of implied volatility. As we go through this course, we'll come across one concept that links optionality, the option of doing or not doing something embedded within a financial security, volatility, the topic and concept that we've just covered, and convexity, a topic that we'll cover or introduce when we start working with fixed income securities. So over the course of this chat, when we come right towards the end, we learn a very important lesson that allows us to link optionality, volatility, and convexity. I just want you to hold that thought in your head as we move forward. So what does volatility look like? What I'm going to show you is an interesting collection of data gathered by Ronald McKinnon at the Stanford University on the volatility, the exchange rate volatility of the US dollar and a number of Asian and non-Asian currencies from the period starting from 1990 to 2004. The series that you see is on a daily basis. So here goes. Now I want you to focus on the results for Thai baht and the Malaysian ringgit. As you can see, moving into the financial crisis of 1997, both the baht and the ringgit traded at vol levels that were actually quite nominal. And while there was some volatility in the Malaysian ringgit as far as the baht was concerned, it was reasonably stable. Then comes the Asian crisis, and vol levels jump from under 0.5% a day to over 6 to 8% a day. The ringgit flattens out in 1997, and the reason why it flattens out is because the currency goes off the float. It's no longer fully convertible. But if you look at the peso and the Japanese yen, you can clearly see that while the baht and the ringgit and the peso were very, very volatile, the yen weathered the storm reasonably well. Moving on to the next set of currencies, the one that really stands out, or rather two that really stands out, the first is the Indonesian rupiah and the second is the Korean won. Once again, you can see that with the rupiah, there was a huge spike or surge in vol as the crisis broke, and that spike lasted for the next 4 years. Compare this with the Singaporean dollar and the Swiss franc, as well as the euro or the German mark or the Deutsche Mark as it was called at that point in time. You can see that they're just as stable as the other major currency such as the yen. But the interesting part that Ronald did with respect to this study is the table that comes next. And here you can see that vol has now been broken down into pre-crisis, during crisis and post-crisis level. And if you go back to the rupiah, we can see that vol went from about 0.25% a day to 26.5% during the crisis, and then stayed at a 5.16 level throughout, which basically indicates that vol can jump very, very rapidly from baseline levels to levels that we'd never thought of hitting. And then when the crisis is past, sometimes vol doesn't come down. If you look at the Korean won went from 1% to 11% and then back to 1.9%. The peso went from 1.9 to 5.25 back to 1.6%. The baht went from 0.43 to 8.8 and then back to 1.6%. And the yen and the mark and the Swiss franc stayed at their same levels. So what this tells us is that for the rupiah, for the won, for the peso, and for the baht, the increased volatility stayed. It became a part of the profile of the underlying currency. So the next time somebody talks to you and asks you, what does vol look like? You can very clearly indicate that one way of measuring volatility is the daily return series. The daily change in prices measured from one day to the next and plotted as a series over a period of time. So the question that comes up next is that, is a static measure of vol good enough? Remember, we're still focusing on the question that we'd asked earlier when we started this class. And that question was, how do you understand the distribution? As we clearly saw in the graphs below, volatility spikes very, very quickly and is not constant from one period to the next. What you see is a set of prices for 1, 2, 3, 4, 5, 6, 7, 8 different commodities. So moving from currencies to commodities, what I've done here in front of you in this graph is plot what I call the concept of trailing volatility. So the idea behind trailing volatility is that rather than looking at static vol measures, I would like to see how the vol is moving from one day to the next. And rather than tracking this on a daily basis for one day vol, what I'd like to do is define a series, and that series could be 15 days, 30 days, 60 days, 90 days, or 180 days. The graph that you see in front of you has been calculated and plotted using 60-day volatility for crude oil, refined products, precious metals, other metals, fibers and textiles, grains and feeds, foods, fats and oils. And as you can see, if you look at grains and feeds, you can see that vol started at about 4%, peaks at about 8% at the height of the commodity boom, and then declines and falls all the way under 4%. Then comes refined products that start at about 2%, go all the way up to 7%, and then close at about 4%. Then come crude oil, which starts again at about 2.25%, goes all the way up to 6%, and closes at about 4%. The graph in front of you should clearly indicate that vol is not stable, is not static, does not remain at the same level, and moves up and down quite rapidly. And the reason why you're spending so much time on vol is, again, it's not just about understanding the distribution. As we move forward with the Corn Crash course, you will see that our ability to work, our ability to define, our ability to understand the behavior of volatility drives the type of models we use and the kind of qualifications we attach to the results of those models. While the first graph showed you commodities, the second graph shows you interest rates. In this specific instance, you'll see that the interest rate volatility here is also cyclical. And you go from numbers going from 0.25% a day all the way up to about 1.7 to 1.5% a day. So the vol goes up and then comes down depending on what is happening elsewhere in the cycle. The third piece takes you back to currencies. Now the interesting thing here is, if I take back, look at the trend line. So grains and feeds peak in 2008, crude peaks towards the end of 2008, and when I come to rates, rate peak beginning of 2008 and then up again beginning of 2009, and when it comes to currencies, they peak right about the time that oil is coming down. Once again, you'll see the same phenomena here. Vol starts at low level, then goes up, then comes down. However, it does not come as low as its original levels. So what do the pieces that we've seen so far teach us about our understanding or behavior of volatility? Exchange rates in 1997, commodities in 2008-2009, interest rates in 2008-2009, currencies again in 2008-2009. Let's look at how the market addresses or handles this change in volatility over a period of time. To do this, we have to start or work with a very simple model. The model that you see in front of you right now is a model that we all studied in basic finance. It's the core of international finance, and it has four key components. The first component is the interest rate differential, which is defined as the difference in interest rates between the two currencies, where one currency is a local currency and the second currency is a foreign exchange currency. Second is the expected interest rate differential. So if my expectation of inflation rates is 1% for one currency and 0.5% for another currency, the differential between these two expectations will be calculated for the second box. So the first relationship here is that the interest rate differential is, on average, just about approximately equal to the expected interest rate differential. Second relationship is that the differential between forward and spot rates is approximately equal to the interest rate differential, as well as the expected change in spot rates over a period of time. So if you deal with foreign currencies, if you deal with exchange rates, if you deal with buying and selling currencies in the forward markets, this is the primary model. This is the primary theoretical model, the primary empirical model that we tend to work with over short periods of time. How does values generated and created from this model relate to actual market prices? Let's take a look at the following series. What you now see in front of you is the same model at work, but compared to market prices. The concept of swap points refers to the cost of buying a currency in the future. So if I want to sell yen and buy dollars 1 week down the road, or I want to buy dollars and sell euro, or buy euro and sell the franc, if I were to plot these prices over a period of time, I would see the graph that you see in front of you. Now in this graph, the blue line refers to the actual market price, the price that the market was quoting. The red line is the model price that came from the model that we just discussed earlier, where the interest rate differential is approximately equal to the expected interest rate differential, which is approximately equal to the expected forward and spot differential, which is approximately equal to the expected change in spot rates over a period of time. Right? So this model generates the price that we see below. And as you can clearly see, while in February there was some traction between the model price and the market price, that traction quickly went away, and you could clearly see a fairly significant gap from March to May, and then an increasing gap from June to August. That's 1 week. So from 1 week, if you move to 1 month, once again we see a similar picture. The red line has moved upward. Previously it was just over a couple of basis points. Now we're looking at 1 point. However, at the same time, the differential between the market price and the model price remains. More to the third example, over here we've gone from 1 month to 3 month swap points, and now you can actually see that the model initially in February was overpricing the risk, whereas by the time you got to May, June and August, you again saw the same differential. And finally, you come to 6 months and 1 year. And at 1 year, we see that there is more or less approximately a perfect fit between the two approaches. So what explains this behavior? Why are things that different? Basic pricing model, a huge differential in 1 week swap points, still some differential in 1 month swap points, then 3 months, then 6 months, and then 1 year. The reality is very simple. From the market where this example was taken, the only liquidity that you see, the only liquidity or level at which transactions occur is the 1 week and the 1 month level. All other prices that you see for 3 months, 6 months, and 1 year are indicative prices. There's hardly any transaction happening in the 3 month, 6 month, and 1 year bucket, which basically means that the market, given the understanding that these are indicative prices, is actually using the model to quote prices, which then make it to the graph that you see in front of you here. So the underlying lesson is, while models are important for our understanding, important for us to track results over a period of time, in reality, market prices and model prices are always likely to diverge. There is a bit of calibration that happens from one point to the next, from one business line to the next. However, the impact of that calibration is limited. So now, the primary question that comes up is, why is there such a huge divergence in prices over a period of time? And this is just in one market. The reason why we see such divergence is the chart that you see in front of you. What I've done here is plot a number of random distributions for illustration. The first is the uniform random distribution that assumes that all events are likely. Second is normal, the third is log normal, the fourth is gamma, the fifth is Pareto, and the last one is extreme. If you look at the structure, you'll see that while there are spikes, the impact of a spike is very different depending on the distribution in question. For the extreme value distribution, while within the normal distribution, the maximum value that you're likely to see is maybe a 3 or a 2.5 or a 3.5. When it comes to the two log normals, you can go as high as 5. When it comes to the Pareto or the extreme value distribution, you can go as high as 25. And that, in essence, is the story here. The market understands that while the model can only work with the normal distribution and will quote prices as high as 3, 3.5, the likelihood of seeing a 5 or a 25 is quite high, especially in an emerging market currency that is under pressure or that is just about to experience a run or a run on its currency. The differential that you see here between the 1 week rate, especially towards August, between the model price and the market price, is a reflection of this assessment by the market. By the time you come to the 1 year rates, you can see that because the market does not expect, does not anticipate to be taken up, to actually do a deal on the price it's quoting, there is not that much of a differential between these prices. So before we close our topic on understanding the distribution, I just quickly want to leave you with one last and final thought. The last and final thought is the real world is very different from the model assumptions or model distributions that we tend to work with. Our only defense against these differences is our ability to truly understand what the distribution that we are working with is capable of. If we are aware of its capability, if we are aware of the surprises, the shocks that that distribution can throw at us, we are much better, much well prepared as risk managers than otherwise. An old friend once said to me about working with models, and I've sort of remembered this thought for a very, very long time. All models are wrong. Some models are more useful than others. This video has been brought to you by financetrainingcourse.com. For a number of additional similar courses, training materials in PDF file format, sample Excel files, and models, please see financetrainingcourse.com. Thank you.